One of the best way to invest is to own a real estate property, and I definitely wanted to have one. But the problem is I don't have the money to invest.
We still can?
Wait, what? We still can?
Yeah!
Yes, we can still invest in real estate even if we don't have the 20% down payment. Look no further than REITs or real estate investment trust. These companies own or finance income producing real estate across different property sectors. By law, these companies are required to give at least 90% of their income to shareholders in the form of dividends. This means that you can earn a steady stream of income from your REIT investment, just like how a landlord would from their rental properties. Plus, REITs also offer a potential for value appreciation, just like owning a physical property. So for today's video, let's talk about owning REITs in your portfolio. Like what we mentioned earlier, REITs are required by law to distribute percentage of their income to shareholders in the form of dividends. This makes REITs a very attractive option for those investors who are looking for a steady stream of income. There are different kinds of REITs: equity REIT, mortgage REIT, and hybrid. One example of equity REIT that focuses on a steady stream of income is Realty Income. This company owns a lot of commercial properties like retail buildings and shopping centers, which are leased to tenants on a long-term basis. Some of their tenants are Walgreens, 7-Eleven, Home Depot, Dollar General, Walmart, CVS, and Kroger. Realty Income is also known for their steady and reliable dividends. And they even earned the nickname the Monthly Dividend Company for their policy of paying dividends to shareholders on a monthly basis. They've been consistently increasing and growing their dividends for 26 years straight. Besides dividends, REITs can also provide growth potential for your portfolio. REITs often invest in commercial properties like office buildings, shopping centers, and apartments. As these properties appreciate in value, so do the REITs that owns them. So in addition to the income provided by the dividends, REITs can also have the potential to provide capital appreciation. An example of this is Stag Industrial, ticker symbol STAG. This company focuses on owning and operating industrial properties such as warehouses and distribution centers. One of their tenants is Amazon. Yes, this Amazon. And as e-commerce continues to grow, the demand for industrial properties is also increasing. Stag also actively develops and acquires new properties, which can potentially provide capital appreciation. It also follows a strategy of acquiring properties at a discount, which improves the portfolio and add value to shareholders. Full disclosure, I'm invested in both Realty Income and Stag Industrial. Right now, I have a total of about 55 shares of Stag with a total market value of $1,992. Monthly, I receive $6.78, and the total dividends that I receive from Stag is about $150. For Realty Income, I have 38 shares with a total market value of $2,325. Monthly, I receive $9.50 of dividends, and the total dividends that I receive from Realty Income is $230. Investing in these REITs is one of my strategies to diversify my investments across different sectors, such as retail properties and industrial real estate. This diversification will help me spread risk and provide balance of yield and growth potential. Another strategy is to invest in REITs at the different stages of their growth cycle. For example, you could invest in a REIT that owns stable properties. For me, this is my Realty Income investment, as well as one that is actively developing new properties and has the potential for capital appreciation, which is the role of Stag on my portfolio. If you're getting value, let me know by hitting the like button, and don't forget to subscribe to get more videos like this. When considering investing in REITs, make sure to do your own research and analysis to make sure that the REIT is a sound investment. Let's talk about some of the fundamentals that investors should look at before investing in REITs. A high occupancy rate indicates that a REIT's properties are in demand and generating consistent income. We don't want to own a property wherein it's just sitting there and not making any revenue. We also want to look at the REIT's diversification. Not putting all your eggs in one basket is one of the best ways to manage and minimize risk. Like what happened last 2020, majority of us went from working in an office to working from home. And guess what happened to all those office properties? Their revenue decreased, and some of them even lose 100% of their income. And these REITs felt the effect since they are focused and concentrated in the office space. We also need to look at the management team. A proven track record can make a big difference in the success of a REIT. It's important to research the management team's experience, strategy, and the history of delivering results. The company's financials is one of, if not the very important details that we should be reviewing as an investor. You can start by looking at the company's debt and liquidity, cash flow, and the dividend coverage. It's also worth looking at REITs fundamentals like price to FFO ratio and dividend yield, which is commonly used in REITs analysis. These ratios help investors to evaluate whether a REIT is overvalued or undervalued. Keep in mind that these are just few things to consider, and it's always a good idea to consult your own financial advisor and do additional research before making any investment decision. We also should not forget the pros and cons of this kind of asset. Because everybody loves happy ending, let's start with the cons. Dividends from REITs are taxed as a regular income. If you're here in the US, dividends from REITs are taxed a bit higher compared to a regular dividends. REITs are also subject to market risks like all assets are. So minimizing your risks by understanding and learning more about the assets will help you maximize your return. You should also look at outside factors such as interest rates, changing tax laws, geography, debt, and property values. The reason behind this is that REITs may charge a high transaction and management fees, resulting to low payout for shareholders. These are just some of the list of cons that you should be aware of, and you can always look them up to get more educated investment decision. Now with the pros. REITs are very liquid. Selling and buying properties may take a while and may take a lot of time, but REITs, on the other hand, are an excellent liquid investment. You can sell and buy a REIT with just a click of a button. If you need money from your investment, you can easily free up some cash. You can also enjoy diversification. Since we own a REIT, all the properties inside this REIT are also part of our portfolio. Since REIT must pay 90% of its income to shareholders, they tend to have a higher dividend yield. It's common for a REIT to have 5% or more safe dividend yield compared to a stock with an average of 2%. So there's no doubt that investing in REITs can be an excellent choice for investors who aims to reinvest their dividends or needed income and let their gains compound and increase over time. REITs can be a valuable tool for investors who are looking for a balance of yield and growth in their portfolio. By diversifying your portfolio across different sectors, you can spread your risk and take advantage of potential income and capital appreciation. But of course, REITs are just one of the many investment vehicles that we can invest our money in. A lot of super investors invest their money in different stocks and sectors. To get to know where billionaires like Warren Buffett invest their money, you can click on this video where we discuss super investors and where to find their portfolio.